Ladies and gentlemen, good day and welcome to the Q2 FY23 and H1 FY23 call of JK Lakshmi Cement, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Melissa. Good evening, everyone. On behalf of PhillipCapital India Private Limited, we welcome you to the Q2 FY23 and H1 FY23 call of JK Lakshmi Cement. I need to highlight that JK Lakshmi Cement is also the holding company of Udaipur Cement Works Limited, and therefore the call is also open for discussion about the performance of Udaipur Cement Works Limited. On the call, we have with us Mr. Arun Kumar Shukla, President and Director, and Mr. Sudhir Bidkar, CFO of JK Lakshmi Cement. I would like to mention on behalf of JK Lakshmi Cement and its management that certain statements that may be made or discussed on this conference call may be forward-looking statements related to future developments and current performance. These statements are subject to a number of risks, uncertainties, and other important factors which may cause the actual developments and results to differ materially from the statements made. JK Lakshmi Cement Limited and the management of the company assumes no obligation to update or alter these forward-looking statements, whether as a result of new information or future events or otherwise. I will now hand over the floor to the management of JK Lakshmi Cement for their opening remarks, which will be followed by interactive Q&A. Thank you, and over to you, sir.
Thank you, Mr. Vaibhav, and good afternoon, ladies and gentlemen, for this and welcome to Q2 call for FY23. We have with us, as Vaibhav mentioned, Mr. Arun Kumar Shukla, our President and Director, and also my colleague, Mr. Rajesh Sharma. The results you would have seen, I don't have to harp on or repeat the results. So to save on time, let's keep the floor now open for question answers, please.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. We have the first question from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Good evening, sir. Congrats for the results in tough environment. My first question is, can you highlight versus peers, our volume growth have been a bit tepid, but our realization seems to have a significant difference versus what most companies have reported in the sector. So, is there any material difference in our strategy in past 6 months which have helped our realization better versus the peers?
Yes. So, good afternoon, good evening, Pradeep. I think our focus when it comes to prices and realization has been on a couple of things. One, of course, how we are going to optimize the geo mix. So that is one area which we have been focusing on for the last so many months. Second has been the premium product proportion which we are driving, because we do have some good products in our portfolio, and we are trying to take leverage of that. And third, of course, I think other elements like product mix and segment mix also, which has been in the focus of our team and JK Lakshmi Cement as a whole to drive realization and the top line.
Sure, sir. So, what would be our trade mix and OPC mix currently, and how do we look at 12 to 18 months from now?
Blended cement production is about 67%, right, and 33% is OPC, and trade also we are at about 54-55% now. There has been good improvement in the past few quarters. on account of segment mix, which is trade and non-trade, and product mix, which is blended versus pure cement.
So, sir, how has it changed like in past year, and how do you see that moving forward next 12 to 18 months from current run rate?
Yeah. So you are asking about the outlook, business
So
outlook,
trade
or
mix,
the
so
yeah.
trade mix has been now 54-55. I guess it was close to 50% earlier.
Our plan is to take it to beyond 60% in the next maybe 2-3 quarters, right? And blended proportion to about 72 to 75%. So that is what our plan is.
Okay. And is there any specific focus on overall profit per ton as a business under new leadership?
Yeah.
Really,
I think I'll give you the focus because it's very important, and it's not only about top line, but I think you have to really look at the all elements of your balance sheet, right? So while I said that our major focus is on the top line. Of course, I think we need to grow our volume. We need to grow our volume in the right markets where our competitiveness is better than others. So this is one. Second, I told you about segment and the product mix which we are driving, and third, of course, the premium product which we have with us. So this is what the focus is on our top line. Of course, I think focus is on utilizing our full capacity, be it grinding station or clinkerization unit. And we are keeping a very close eye on each and every element of cost, be it our logistics cost, be it our fuel cost, fuel mix, or power cost. I think this is what our focus is. While we are working consistently on top line improvement, but at the same time trying to better our performance in terms of efficiency at the plants and all other value links which takes our cement to the customers.
The last question on your capex project, the UCW project, the timelines for commissioning of the same and the status of environmental clearance, etc. for that project.
Yeah. So on Udaipur, 75% civil work has already been accomplished. Our target is to accomplish our clinkerization unit by.
We hope to complete that project by March 24.
March 24, right?
So the clinker plus grinding all by March 24.
That is as of now.
So maybe I think clinker would come a little earlier, so maybe around March, and a month or two later is going to be the grinding capability.
Thank you, sir. I'll get back with you. All the best.
Thank you.
Thank you. Participants who wish to ask a question may enter star and 1. We have the next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. Before asking the questions, sir, a couple of data points. First is non-cement revenue and the RMC revenue for the quarter.
Non-cement revenue is 116 crores and RMC is 52 crores.
Okay. And premium share was how much?
Can you repeat?
Premium share. Last time you said 14% of total sales is a premium product share. So what was in this quarter?
Is more than 20. It's around 20. More than 20 was 21%. I suppose. Yeah.
21% of trade sales or the total volume?
Total sales.
So 21% is
21% of
yeah. 21% of trade sales.
So, sorry, sir. 21% of total volume is a premium share.
21% of trade sales volume.
What was the same number in 1Q FY23 last quarter?
I think it was a percentage and a half lower than this.
Okay, 19.5%. Okay. What was the lead distance in the 2Q?
Q2 lead distance just
About 395 kilometers.
395, yeah.
Okay. Sir, still, once again, I want to reiterate the first questions again. Still not able to understand clearly in terms of the realization, the growth that we have seen last 6 months, particularly Q1, we have seen a 12% plus, and this quarter only 0.4% decline, though you have mentioned, but if you can elaborate more, because this is that's the thing that is definitely positive for us, but we are still not able to understand. And how do we see in terms of the pricing post September, how much price increase we have seen in each of the states or the region where we operate? So that I want to understand.
Yeah. So on pricing, July, September typically is low demand-wise, and hence prices also were under pressure. Overall, we see industry-wise, we see a decline of about 5% in the prices, right? Okay, so July, August price-wise, I think there was a lot of pressure, but September prices revived little bit during fag end of the month, maybe after 15th or so, right? So we have seen revival of prices towards end of September, and now onward, I think this is going to take a steam because demand is improving, right? So this is on market side. If you really look at our net sales, it has gone up by 8% YOY, right? And if you compare this with previous quarters, it's gone down by 3%. Okay, so while industry, our estimation is about 5% lower. We are down by about 3% lower than the preceding quarter, and 8% up with respect to corresponding quarter.
Sir, that I understood. But if I look at our trade sale share has not increased; it has remained. Rather, from the last quarter, it was 56%. Now it is 54-55. Nothing has much change in terms of the premium share, also 1.5%. But the realization increase. So not only I think the entire street just wanted to understand in detail in terms of if we divide revenue by the volume, the realization growth that we are seeing in the first quarter and the second quarter of this year, it is much higher than the entire all other peers. So that thing we are not able to understand. So my question is on the console level. So I understand on the standalone last quarter we have changed the method, but on the console level, nothing change, it remains. But still we are not able to understand what is driving our realization growth.
And I'll tell you, Shravan, I think it's a very good question, and in fact, you have noticed when I started my conversation, the first priority, of course, is geo mix, right? Typically, our presence is there in north, west, and east part of India, part of east, right? Prices in western part of India is better. So our effort was to maximize our sales in western part of our footprint, where prices are better. Just for, give you, to just elucidate this, non-trade realization or margin in case of west is much higher than trade in, let's say, some part of north and even, part of east, right? So our focus was to first, optimize the geo mix. How we can sell more in the area where our margins are low, irrespective of the segment. So that is what is the first effort is, and that is what we have done in the previous quarter and even before, right? So we are consistently increasing our volume share in this part of geography where our margins are better, irrespective of the segment. This is one, right? And then there comes, thereafter, within that area, how we are going to optimize or maximize trade, right? So suppose, north, we have optimized, segment mix or geo mix, let's say, more sales in western part of India. And when it comes to north, then we are optimizing our, trade and non-trade or segment. If you go to east, the same way, right? So wherever our margins are better, first we go for geo mix and then we go for non-trade. So it's a kind of, hierarchy which we follow, right? We are not really looking at, segment per se, because why, at all we have divided that, sale into segment? Because of the profitability of market. If you get better margin in non-trade segment, I think we are not averse of that. And that is what we have done in previous quarters as well.
Okay. So just further more on, does our trade non-trade price gap in last 6 months has it reduced significantly versus Q4 average?
Yes, this has gone down.
How much was the in Q4 and now in last 6 months? How much it has reduced? What is the difference gap between what we sell in trade and non-trade? On an average, I'm not asking the exact number, but broadly.
I think Shravan, range is so wide, so average would not be the right one. So I'll just give you example. In case of West, the gap in trade and non-trade is very low. It's about, maybe about 200 rupees a ton, right? If you go to Rajasthan and northern part of it, the gap is about, 1200 to 1400 rupees a ton. If you go to East, I think gap is about, 400 rupees, right? So averaging would not be the right way of looking at this, gap between trade and non-trade. But there is a huge, I think, wide band. So, and that is why I told you that, first focus was to really kind of, capture some non-trade also in western part of our footprint, where trade non-trade gap was the list, right?
Okay. Last question is on the power and fuel mix. So what was the fuel mix for this quarter? And on the fuel consumption cost, because last quarter we said 11,700, and how do we see, though we expected 20% increase this quarter, but it has only the 10%. So how do we see now in the third quarter the power and fuel cost?
In this quarter, our petcoke consumption was about 48%, 39% was coal, and balance was the others. Broadly, it will remain the same in the coming quarter. Cost was, yes, you are right, we had thought that it will go up, but thanks to some additional low-cost inventory, we were able to curtail it down to less than 12,000 rupees. Going forward, we see that overall fuel cost going up from 12,000 to 13,000 in the coming quarter.
Okay, so currently for Q2 it was 12,000 and it will increase to 13,000.
That is what our expectation is in the coming third quarter.
Okay, and last on the working capital, sir, we have seen the 420 odd crore increase in the first half for on Concall basis. So do we see this once again reducing in the second half? So that if you can clarify.
That is increase in working capital is on account of the stocking of the petcoke and coal, primarily on account of that. So it may, depending on our strategy going forward of sourcing petcoke and coal, it is expected to come down. That is what we believe.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good set of performance. So, because of one question, like since we had changed that volume accounting or volume presentation for standalone operations right from Q1 FY23, so can you give the numbers for the Q1 and Q2 of last year to have the like-to-like comparison?
Because it will be erroneous for us to give, because last time we had accounted for as the clinker sale and all that. So that will not be proper. But for the sake of giving the figures, I am telling you, in the corresponding quarter last year, we had total on a you want on a consolidated basis, no?
Because what happened that there are some doubt in the market that our volumes in the standalone has gone down because we don't have the like-to-like volumes for the last year on the standalone front.
I'll give you that on a standalone basis. This year you have the volumes. 22.36 is cement sales and 0.69 is the clinker sale. Yeah. Total in this quarter is 23.05.
Yeah.
In the corresponding quarter last year, our cement sale was 20.43. So there is an increase in cement sales by 7%. But clinker has gone down. Last year it was in corresponding quarter 1.48. So that has reduced from 1.48 to 0.69 clinker sales. Overall, it is this time it is 23.05. Last year it was 21.95. Overall growth is 2%, clinker and cement included. But importantly, cement has gone by 7%.
Okay. And same for the Q1, sir, last year?
Q1 I don't have ready because I have for the corresponding figure quarter I have kept it ready.
Okay.
Right?
Okay. And sir, lastly, if we see our performance or the margins in this quarter, they have been far better, and the way the gap between our and the peers, the margins have the gap is hardly around 100 rupees now. So going forward, I believe in this quarter we had some benefit of low cost coal, which peers may not have. So going forward, do we see this particular trend going on, 150 to 100 rupees gap? Because over the years we had this particular argument that on the logistics front we are not that competitive as against peers because of our plant's location in Siroi. So have we been able to contain that particular impact? Our margins going to remain now the gap is going to remain 50 to 100 rupees compared to our peers. So what's the thought process on that part?
Actually, I can't comment on the fuel cost of the other players. We can talk of what we are doing. As I mentioned in response to an earlier question, our fuel cost is expected to go from about 12,000 the cost to about 13,000. I don't know about the other. But yes, this quarter we have been able to substantially reduce other overheads. Our endeavor would be to continue to work on that and improving, as Mr. Shukla mentioned, the geo mix, etc., which helps us to reduce the logistic cost also. Doing more of direct dispatches and trying to reduce on the lead etc. So that should help us to bridge that gap going forward.
Okay. And sir, any measures we are taking in East market to bring down our power cost or anything, any particular effort going on there?
East, we are trying to evaluate the possibility of increasing from the renewable sources, trying to see if we can put additional solar power to reduce the cost of thermal generation, and that we are evaluating.
Okay. So what is the potential there, sir? What can we do there?
We can do about maybe because of the availability of we can go up to an additional, we'll need to make some investment. We are evaluating the proposal, maybe about 30-40 megawatt we are trying to evaluate.
Okay. And lastly, sir, just one analysis.
Of doing the entire capex in our books, we'll try to get some implement the project for us, and we take a stake in that. Because as of now, the state of Chhattisgarh allows the various benefit under the captive route by taking only 26% stake. So we are evaluating as of now. So that will come with the concrete plan going forward, maybe in the this quarter.
Okay. And so lastly, on the Concall side, if we take out the non-cement revenues, then it seems that realizations have fallen by 94-95 rupees. So it's not the case that our realizations have not fallen. It has fallen, but to a very less quantum, that is 94 rupees, because you have provided the non-cement revenues. So based on that, your realizations have fallen 94 rupees. So is it on the correct line?
Yeah, other players who were commenting, other colleagues of yours who were commenting was maybe because of non-exclusion of the non-cement revenue. Yeah, last year in the corresponding quarter, it was 92 crores. It has gone up non-cement revenue to 116. If you eliminate that, what you are saying may be right.
Yeah. Thanks a lot, sir, and great, sir. Great set of numbers.
Thank you.
Yeah.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
No, my questions have been answered. Thank you very much.
Thank you. We have the next question from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Hello. Yeah, hi sir. Good evening. I have a few questions. Some of them have already been answered. Could you share the clinker production number for this quarter?
Sorry?
Clinker production in Q2.
Clinker production in this quarter was 19.47. 14.9.
Sorry, can you repeat please?
14.69 lakh tons.
15.69. This is standalone console.
14.69.
Standalone or console, sir?
This is standalone. And UCW was 3.8, so on a consolidated basis, the clinker production is 18.49.
Okay. Sir, if I look at the purchase of traded goods, that number has shot up considerably. I assume this is with regard to the only the arrangement with Canadian Cement. So, how is this being accounted, sir? You're booking sale of clinker to them and the purchase of cement from them, and subsequently sale of that cement is booked into the top line again?
Yeah, that will be the way it will be accounted for.
Okay. And how much would...
We have to do that way.
Okay. How much would be the volume from this Canadian Cement, sir? That would be in Q2 numbers?
About 70,000 ton, right? So we started during this monsoon season. End of August. We have done about 70,000 tons.
Okay. And by March, what sort of number you're looking at?
So we have a ramp-up plan for this outsource unit, and we have a plan to take it to 65,000 ton by March 2024.
65,000 tons per quarter?
No, per month.
Okay. And this quarter has been a small, just 70,000 tons. Okay. So, yeah. Okay. If you're looking to increase your blended cement, by another 600 to 700 bits, and similarly trade share should go up. So, do you be a sharp jump in next three, as you mentioned, 2 to 3 quarters? So, what are the strategies which are helping you, which gives you confidence?
The question is not clear. Your voice is...
Hello?
Voice
yeah, am I audible now?
It's slightly better.
Yeah. Sir, I wanted to understand from 54% trade sales, you're looking to go up to north of 60% over next 2 quarters. And similarly, your blended cement share is also expected to expand, and which is a good thing, given that you're, running high on clinker utilization. So, what is giving you this confidence, in terms of your strategies, distribution?
I think we are reasonably confident that the steps which we are taking at the ground level, that is going to help us. And more so, I think, all those efficiency, ground logistics efficiency which we are looking at, I think that will also help us to achieve this. So we are reasonably confident that this will help us to achieve our objective of blended.
Okay. Okay, great. Second question pertains to an earlier participants have also wanted to know this. In terms of realization, see, we understand sequentially all markets witnessed pressure on the realization. While on blended basis, your numbers don't reflect that. But for your own markets, can you give us a sense what was the like-to-like realization for across north, west, and east markets for you in Q2, quarter on quarter?
I think market-wise, we are not ready with all those realization data. What we have as of now is the consolidated one. Perhaps I think we can maybe we can discuss or send you separately this data.
Sure, sir. I'll discuss with you on that one. In terms of 2 more questions on the green power usage, what is the current green power consumption, and what are the targets from a FY24, say FY24, what sort of green power number you're looking at on consumption basis?
So, we are working quite intensively on improving our green power proportion. And right now, we are close to about 35% of our consumption through renewable source of energy.
And where do you see this number going up?
So we see that this number should go to about 37%. From currently we are at 35%.
Okay, you're already on the higher side. And the other expensive numbers on a per ton, if I look at quarter on quarter, they have come off despite lower volumes quarter on quarter. So is there any deferment in the maintenance expense or some other cost which was building up in Q1 has not come through in Q2? Could you explain the Q2 other expense numbers?
Other expenses have dropped in this quarter, you are right. But a major portion of that is like other expenses includes packing, commission, stores and spares, which are in direct proportion to the change in the production. So production has fallen, so have these expenses. But overhead, we have slightly been able to reduce on that. So broadly, the fall is in line with the fall in the production.
Thank you. We will move to the next question from the line of Naveen Sahadev from Nuvama Securities. Please go ahead.
Good evening, sir.
Good evening.
Good evening.
Yeah, and congratulations on a very good set of numbers, much ahead of street expectations.
Thank you.
So two questions. One is, are we also looking at, or in a way already able to narrow the price gap versus peers? Because since Shuklaji in his initial comment said the prime focus is on the top line and revenue. So I'm saying, is there already an implementation or a thought to narrow the price gap? How do you see this?
Yes, I think you're right. This is one of the major value driver when we talk of top line. And we do have, identified few actions which we have started implementing market by market. And perhaps this, implementation part would be over by end of this quarter, or maybe it will extend till about, January. And hopefully, I think February, March onward, we see that in our price gap will dwindle. And we have clarity in our thought as to what we need to do in order to reduce this gap. So all those actions are being taken. Yeah.
Appreciate. Second question then I had was on the cost front. So, of course, I think on the power utilization front, in terms of overall energy consumption, I think we are already at a fairly low level, even I think both at clinker stage as well as at the cement stage. And you said you are looking at adding some waste heat recoveries or more green renewable energy per se at the eastern plant. Apart from this, what are the other initiatives which are possible to pull the cost down further, both from a near term or even if it's a medium term kind of a thing? What could be those avenues, sir?
Okay, so I think renewable is one part which we are working, which is going to help us to reduce cost. So that I told you that we are already at 35%, we'll go to 37%. Another big area where we are working on is alternate fuel, AFR. Right now we are at a not so great level, like about 3.5% level. Our plan is to take this AFR proportion to 10% in the next 9 to 12 months time. And for that we have already started developing our capabilities at our integrated units. That is second major action which we are taking, right? And third action also is on how we can really use cost effective raw materials. So just to give you an example, maybe mineral gypsum versus phosphogypsum, right? Chemical gypsum versus mineral gypsum, fly ash, right? Also, I think different, sourcing fly ash sources and different kind of fly ash availability. So that is another thing. Raw material part also we are looking at very closely as to how we can use all those, resources to reduce our costs without compromising on our promises to customers. So that is another thing which we are working on. And as you know, I think we are already competitive in terms of, heat value, power consumption, but we are not at all complacent, let me tell you. I think there is an endeavor to further reduce these, cost elements by two ways. One, of course, straightway improvement of, efficiency. Second, also, if we can improve, productivity to an extent with, some low capex interventions. So these are the few actions which we are looking at.
Great. I really appreciate. So I'll just leave this with one feedback that while JK Lakshmi is taking so many efforts, to spruce up the profitability, it will be really great if, if you can also have some sort of a quarter presentation which gives volume data and, more importantly, the ESG milestone targets if there are, because most of the companies, other cement companies, tend to talk about this, and investors also incrementally are getting aware of ESG targets and the roadmap that the company has. I think if you include it in a presentation form, it will really help JK Lakshmi really bridge not just the realization gap which you are trying, but also the valuation gap in my view. Thank you.
We'll do that. We'll upload that on the website in the near future.
Thank you.
Thank you. Thank you.
Thank you. We have the next question from the line of Simran Jeet from Omkara Capital. Please go ahead.
Yeah, thank you for taking my for giving me the opportunity, and congrats to the good set of numbers in the challenging environment to all the management. Sir, sir, I have only one question. I understand what is the JK Lakshmi.
Your voice is breaking. Can you repeat your question, please?
Yeah, now it's fine. I'm audible. It's fine now.
Yeah, better.
Sir, I just want to understand what is the JK Lakshmi focus on the debt, to bring down the debt of the Udaipur cement. How the company is focusing on that in the future. Because you are still having close to 1,000 crore of debt, mix of long and the short in the Udaipur cement. So that is the only point which I want to understand. How the JK Lakshmi Cement is focusing on bringing down the debt of Udaipur.
Basically is in the process of implementing this project of expanding its capacity in clinker of 1.5, which will take their capacity from 1.5 to 3 million, and cement capacity from 2.2 to 4.7. Then that project will cost 1,650, and we are planning to contract and fund that through a debt equity of 2:1, contracting 1,100 crores of debt. So basically, we don't have any immediate plans to suddenly bring down the debt. They already have about 500 crores of debt based on the existing capex which they have done in the recent past, and gradually it will get paid off from their cash flows only. No immediate plan to as such pay off any debt, because otherwise that will require induction of funds from JK Lakshmi only. We are in any case going to fund about 400 crores through the rights issue which will come in the next year. So no immediate plan as such, but yes, to the extent possible, we try to pay off from their cash flows only.
This 400 CR of the right issue is for the Udaipur or from the JK Lakshmi? Just want to understand. Means 400 CR, right?
Udaipur, they are part finance the expansion project. So out of 1,650, 1,100 crores comes by debt, and 550 is the promoter's contribution, and out of that 150 comes from their internal accrual of UCWL and 400 crores would be the right issue size of UCWL. And JK Lakshmi being a 72% holder of shares in UCWL will have to fund a major portion of the rights issue. Balance 28 coming from the public.
Okay, got it. Done, sir, done. Thank you and all the best for your upcoming future performance. Thank you, sir.
Thank you.
Thank you. We have the next question from the line of Rashesh from ICICI Securities. Please go ahead. Mr. Rashesh, your line has been unmuted. Please go ahead. Rashesh, your line has been unmuted. Please go ahead. We will move to the next question from the line of Parth Bhavsar from Investec India. Please go ahead.
Hello.
Yes, please go ahead.
Thank you for the opportunity. Sir, I just had one question. That you said that your geo mix is improving and the focus going ahead would be on the geo mix. So can you help me with this, in this quarter, what was the geo mix in percentage terms, if you could share?
So we have divided the different geographies into G, Y and R, we call it, green, yellow and red.
Okay.
So green proportion is going up month after month, right? And our green proportion as of 30th of September was more than 55%.
Okay. So green is basically blended cement?
No, green is based on the margin, right?
Okay.
You talked about geo mix, right? So I'm
Geo mix.
talking.
So in terms of west, north and east.
Yeah. So what we have done is all markets are divided into G, Y and R, green, yellow and red categories based on the margins which we get, right?
Okay. Okay. Got it.
So we try to sell maximum quantity in G area, right, where margins are.
Okay. So green is right now at 55, and what was its number last year?
It was about 52-53% before.
Okay, and yellow and red, if you could help.
I think red is dwindling the fastest, right? So red still is about 12% around.
Okay.
Yeah.
Okay. And this was red. What was it? Red last year, sir?
15%.
15%. Perfect, sir. Perfect. Thank you so much.
Thank you. We have the next question from the line of Uttam Kumar Shrimal from Axis Securities Limited. Please go ahead.
Yeah, good evening, sir, and congratulations for a great set of numbers. Sir, my question relates to gross debt and net debt position on standalone basis.
Sorry?
Gross and net debt on standalone basis.
Just a second. Standalone, our total debt on a standalone basis is about close to 900 crores and net is about 225 crores.
285 crores.
225. 900 and 225.
Okay. And sir, we have reported EBITDA turnover around 600 for this quarter. So what kind of EBITDA turn we are looking in quarter 3 and 4 since commodity prices also softened?
It's difficult to pinpoint a figure of EBITDA. Target is to ultimately go up to 1,000 rupees EBITDA, but considering the increase in the fuel cost, it may take some time for that to actually materialize. But endeavor would be to ultimately have a 4-digit EBITDA.
Okay. And sir, what has been our railroad mix this quarter?
Railroad. You see, in East we don't have much.
I think it is. I think rail proportion is the list. Maybe we do not have the exact data. We can give you a little later. We're not carrying that, but I think majority is road only. So that way. Only west, I think, some of the market we go through rail. Otherwise, it's all road. And
Okay, sir. That's all from my side, and all the best for the future endeavors. Thanks, sir.
Thank you.
Thank you. Ladies and gentlemen, this is the final reminder, and there will be no further questions taken post this reminder. To ask a question, you may enter star and 1. We have the next question from the line of Dharmesh Shah from MK Global. Please go ahead.
Thanks, sir, for giving me the opportunity, and congratulations on good set of numbers. Sir, my first question is on the company strategy side from the next 2 to 3 years perspective. And if you can just prioritize the, what are the number 1 priority, number 2 priority?
Yeah, so I'll tell you some, top level strategy I will give you, and this is what in fact we are working on. One, of course, I think we are working with a lot of focus and lot of intent on the top line. And when I talk of top line, then it includes improving volume. It includes quality of volume, which I told you, geo mix, how we can sell in the right area at the right price, right? Our focus is leveraging our brand, because we do have some good products in our portfolio. How we can leverage and really go to the customer with the right value and the right kind of product and services which we have. So leveraging our brand which we have. We are also working on, I think some of you asked the question of price positioning, how we can really improve our price positioning. So this is also a strategy. There are some milestones which we have set for ourselves. We have started working on that, so that is another one. And of course, I think blended cement and trade mix wherever favorable. That is what the top line strategies are. And for each and every element, we do have quantifiable numbers as to what we are targeting and how we are going to achieve that. So those things are in place. When it comes to operations, I think our focus is on renewable energy. How we can really take our renewable energy from 35% to maybe beyond 50% going forward. So for that also we have prepared some roadmap, which is combination of solar power plants, wherever possibility of improving efficiency in WHR, right? Then on fuel, I think our strategy is to improve our AFR, which we are there at about 3.5% now. How we can really go to 10% at the first place and then to 15%. And for that, I think we have already started working on that. We are also working quite intensively on using digital and technology to drive performance. We have started a pilot project in our kiln as to how AI/ML can help us in kind of improving our kiln efficiency and also improving optimal fuel mix. We have also started kind of monitoring all our critical equipments through this IoT, Internet of Things. So a lot of digitalization which is happening in the operation side. At logistics front, our focus is to really work on lead, how we are going to reduce our lead. And if we really achieve our geo mix target, then I think lead is the resultant of. So this is, in a way, I would say the lag indicator, but the leading indicator, of course, is geo mix. PTPK is the pure logistics action which we are working on. How we can reduce, PTPK with a lot of, analytics and also using technology. So OTM we have implemented in all our plants, Oracle Transport Management. So how we can improve turnaround time, and hence if we can really work on reducing our PTPK and logistics cost. That is the other area we are working on. I think a lot of things on customer interface. So using digital to give them a differentiated experience. Like now our dealers can place their order over WhatsApp, right? So WhatsApp bot we have recently launched. They have got their app. They can place their order through mobile, they can look at their account statement and all those stuff. So I think there also I think is going to help us to achieve our, in a way, top line and the positioning which we are seeking for. Our focus also is on ESG. I think which combines, host of things, some of things which I have already mentioned you. But yes, I think ESG front, I think is one of our focus area where we are going to work on reducing carbon footprint. We have taken a very ambitious target of being carbon neutral by 2047. And right now, just to give you a sense, we are at about 555 kg per ton of cement as of today. Our focus is to reduce this and being the among the best in the industry. So that is another focus which we have. So this is what I think broader, I would say strategies which we have, which includes, just to summarize, on top line, driving top line performance in terms of volume, premiumness and pricing. On operations, it's all about operational efficiency using different means like renewable, AFR and digital. On customer front, using digital to really give them the right value and get the right value from them. On logistics, I think using digital and a lot of other methods like OTM and e-bidding, those things we are working on. So this is in a nutshell, I think, our strategies.
Thank you, sir. So secondly, our lead distance are broadly flat on quarter-on-quarter basis, but what does it explain the decline in the freight cost per ton?
Freight cost per ton.
So I'm looking at consolidated basis.
1163, I think. Just look at 1263. It's 1263 per ton.
We are trying to increase the proportion of direct dispatches, which is helping us apart from the PTK and other things.
Thank you. We will move to the next question from the line of Vishal Pariwal from IDBI Capital. Please go ahead.
Yes, sir. Thanks for the opportunity. More clarity, if you can just provide on the band which you mentioned, green, yellow, and red. So, will what kind of the sales qualify for a green? Any particular EBITDA margin or threshold that is there, or it will vary every quarter?
So that varies because based on that situation is quite volatile, right? So this GYR is dynamic. So typically, you cannot really put EBITDA because maybe during quarter one, EBITDA green would have been different than what green is today, right? So this is based on the band of margins which we have from different markets, and based on that, this is dynamically decided that this is what G, Y, and R is. And typically those we have a matrix of, just to give you a little bit more on this, we have a matrix of this total delivered cost in that particular market and the margin, right? In a way, most of the time, I think this is in the direct relationship. If your logistics or total delivered cost is low, then typically you are going to have better margins, unless you have a different market dynamics where prices are not operating that, right? So we have a matrix of total delivered cost and margin and market share. So based on that, we kind of categorize our market in categories of G, Y, and R.
Okay. So just a clarification. So this GYR, it's not a margin. It's a combination of three, is it? Some sort of weightage you have given.
Right. So, but invariably, your TDC is low, then I think typically those markets are going to be falling in that green category. If market dynamics is entirely different, that is a different issue. But that is, I think, very rare, right?
Okay. But then you did mention in this call that West has been a better market. So can we broadly say green is something probably West region or?
Yes, correct. So maybe I think green is the West region, white typically is some of the markets of North, and rate is far off market. Yes, you are right.
Okay, fine, sir. Thanks for the clarification. And last thing is, can you give clarity, like how is the pricing behaving for us in the market? I think you did mention, like, from September onward, there has been a price hike, which is there, moved also there in October. And then can you give us some color, like region-wise, which has been better market for us in terms of pricing in this Q3 probably season?
September, I think I told you that little bit, inching of prices towards fag end of the month. October more or less has been flat. There has not been any increase because of the reasons like, demand was again low, Dashera, Deepavali both in the same month, and also prolonged southwest monsoon, right? But November onwards, since I believe that, demand is going to pick up, and we do have some initial signs, initial sense towards that. The prices will definitely likely to go up, I would say, in coming months, which is going to be better than October.
Thank you.
But again, I think market dynamics, we just based on the demand situation, we can reasonably say that yes, prices will go up.
Thank you. Before we move to the next question, we would like to inform participants that due to time constraints, we will be able to take the last two questions only. The next question is from the line of Ankur from Quasar Capital. Please go ahead.
Congrats on good set of numbers, sir. All my questions have been answered.
Thank you.
Thank you.
We have the next question from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi. Thanks for the opportunity. So, thanks for explaining your focus areas and what you intend to do. On the intent of kind of improving the price realizations, I just want to understand, like, how are you going about it in terms of your distribution network? Are you also trying to revamp your distribution network to do the same, or is it going to happen through the same network?
Yeah, thanks. I think very good question. Also about margin and prices, not only in the function of the right place or the right product, but also the kind of channel which you have. And somehow I think Vaibhav also has mentioned in a lot of his write-ups that this also really affects the margin extent. So yes, I think we do have a strategy, what we call channel strategy. So what kind of channel we are going to set up? Like, is it going to be a balanced kind of architecture, include some big dealers, maybe more mid-sized dealers, and not too long tail, right? Based on the competitive environment and competitive landscape, we do have a strategy to set up a design channel architecture in different markets, right? So what kind of dealers we are going to have, and of course I think that also is part of our strategy when we talk of improving our volume and premiumness in the market.
Okay, got it. And but generally, like when you go about doing some changes in the dealership network, like typically how long can it take to revamp this distribution channel?
I would not say this revamp. I think I would say this process of metamorphosis, right? That takes time, and you do this, gradually and in a designed way, right? Because you are in the market, and I think revamping, I would not really go for entire revamping right away. Probably, I think what you can do is, without, let's just for example, if you want to really grow a certain set of dealers, let's say mid-size or lower segment dealers, then you have your, strategy aligned to that. Rather than, two ways are there, kind of improving a set of dealers, either you kind of, improve their volume and improve their presence, or you reduce the upper one, right? But I would say, I think what we do, I think will improve all of them. And probably the desired one will be improving much more than the other one. So this is the way we are going about it.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference back to Mr. Vaibhav Agarwal for closing comments. Please go ahead, sir.
Yeah, thank you. On behalf of Phillip Capital India Private Limited, we would like to thank the manager JK Lakshmi Cement for the call, and also many thanks to participants joining the call. Thank you very much, sir. Melissa, we want to conclude the call. Thank you.
Thank you, Vaibhav. Thank you. Thanks, everyone. Thank you.
Thank you, members of the management and Mr. Agarwal. Ladies and gentlemen, on behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.